Think of today's economic titans, the Apples, the Amazons, the Googles of the world. Now imagine a reality where, in the blink of an eye, these behemoths crash to their knees, weighed down by billions in losses, corporate missteps, or unforeseen market shifts. This is not a distant, dystopian future. It's a page from the annals of financial history. In this video, we'll revisit the rise and fall of 21 companies that once stood atop the world, only to tumble into the abyss of bankruptcy. Their stories serve as a modern-day Icarus tale, warning of the perils of flying too close to the sun of rapid growth, unchecked ambition, and economic hubris. Lehman Brothers Holdings Inc. Once the fourth largest investment bank in the U.S., Lehman Brothers became the epitome of the 2008 financial crisis when it crumbled under a mountain of toxic assets, mostly tied to the subprime mortgage market. Its bankruptcy filing on September 15, 2008, with $691 billion in assets, marked the largest bankruptcy filing in U.S. history and catalyzed the global economic downturn. Washington Mutual. 11 days post-Lehman's downfall, Washington Mutual WAMU succumbed to the largest bank failure in American history. Once the largest savings and loan association, it was heavily invested in the housing market, and when the bubble burst, WAMU's $328 billion in assets couldn't save it. Its banking assets were eventually acquired by JP Morgan Chase. Worldcom Inc. Worldcom, which had grown to be the second largest long-distance phone company in the U.S., was embroiled in an $11 billion accounting scandal. This fraudulent act inflated the company's assets to $104 billion, and when uncovered led to a loss of trust and a swift decline into bankruptcy. General Motors Corporation. General Motors, an icon of American manufacturing, faced its demise amidst the 2008 financial crisis. With $82 billion in assets, the company declared bankruptcy due to unsustainable debt, pension costs, and a sharp decline in automobile sales. It was later restructured with the aid of a government bailout. CIT Group. Specializing in financing for small and medium-sized businesses, CIT Group filed for bankruptcy after the credit crisis, which dried up its short-term funding. With $71 billion in assets, its restructuring allowed it to continue operations and emerge from bankruptcy by the end of the year. Pacific Gas and Electric Company, PG&E. PG&E's financial distress has been a multifaceted issue, mainly stemming from the catastrophic wildfires in California, for which it faced billions in liability. A utility giant with a long service history, PG&E's infrastructure was scrutinized for sparking some fires. The company, which had assets totaling $71 billion, sought Chapter 11 bankruptcy protection to manage the claims and initiate a substantial overhaul of its operations. This case has spotlighted the broader challenges facing utility companies in the era of climate change, with an increased focus on sustainability and disaster prevention measures. Enron Corp. Enron, once a titan in the energy sector, became emblematic of corporate fraud with its bankruptcy in 2001. The company's innovative approach to energy trading was marred by accounting scandals, which overstated profits and hid debts. Enron's implosion, with $65 billion in assets, led to one of the most significant bankruptcies in history, precipitating the loss of thousands of jobs and the dissolution of the Arthur Andersen accounting firm. The event triggered profound changes in corporate governance and accounting regulations, including the enactment of the Sarbanes-Oxley Act. Conseco Inc. Conseco's bankruptcy in 2002 was one of the largest in corporate America at the time, particularly in the insurance sector. With assets valued at $61 billion, Conseco's financial troubles were attributed mainly to its aggressive acquisition strategy, which included the purchase of Green Tree Financial, a company specializing in financing mobile homes. The acquisition proved problematic as the subprime market encountered difficulties. Conseco's foray into these riskier financial products ultimately led to significant losses, resulting in a restructuring under Chapter 11 bankruptcy proceedings. MF Global Holdings. MF Global, a prominent player in the world of finance, was led by former New Jersey Governor John Corzine. The firm made a series of high-stake bets on European sovereign debt that proved calamitous. In 2011, the company declared bankruptcy with $41 billion in assets after its risky trades failed to pay off amidst the European debt crisis. The bankruptcy was marked by a scandal involving the misuse of customer funds and highlighted the fragility of risk management in the financial industry. Chrysler LLC. Chrysler, an icon of American automotive prowess, faced bankruptcy in 2009 with $39 billion in assets amid the global financial crisis. Its challenges included a dramatic downturn in auto sales, legacy costs, and an inability to quickly adapt to changing consumer preferences for more fuel-efficient vehicles. The U.S. government intervened with a bailout and facilitated a strategic alliance with Fiat, leading to a restructured company that eventually restored Chrysler to profitability and competitiveness in the automotive sector. Thornburg Mortgage. Thornburg Mortgage, established in 1993 in Santa Fe, New Mexico, positioned itself uniquely in the mortgage lending industry by offering adjustable rate and variable rate jumbo mortgages, primarily to more affluent clients. The firm's business model was heavily reliant on the securitization market, where it sold its mortgages to investors. This strategy proved profitable during the housing boom. However, when the financial crisis hit in 2008, the securitization market collapsed and liquidity dried up. Investors were no longer buying mortgage-backed securities, and Thornburg faced a sudden and severe shortfall in funding. The firm was besieged by margin calls it couldn't meet, as the value of its mortgage securities plummeted. With $36 billion in assets at stake, Thornburg Mortgage's liquidity crisis rapidly escalated into a full-blown bankruptcy, becoming one of the largest mortgage lender failures of the financial crisis. Texaco. Texaco's journey from an oil industry pioneer founded in 1901 to a bankrupt entity is a tale of corporate battles and market shifts. The company grew through significant discoveries and expansions, establishing operations worldwide. However, Texaco's aggressive strategies led to a contentious legal battle with Pennzoil over the acquisition of Getty Oil. The result was a $10.5 billion legal judgment against Texaco, which forced the company into bankruptcy despite its $35 billion in assets. This legal decision was one of the largest civil verdicts at the time. It caused Texaco to restructure under Chapter 11 bankruptcy protection. Financial Corp of America. The saga of the Financial Corp of America is deeply intertwined with the savings and loan crisis of the 1980s. As the holding company for American Savings and Loan, it became emblematic of the era's financial excesses. It grew rapidly, often through acquisitions financed by high-risk funding mechanisms that became unsustainable as interest rates rose and the real estate market collapsed. This led to a string of loan defaults, asset devaluations, and ultimately a federal takeover. The company's $34 billion asset base was eroded, culminating in one of the largest bankruptcies of the time and signaling the end for what was once the nation's largest savings and loan association. Refco. Refco began as a modest brokerage in 1969 and evolved into one of the world's largest commodities brokerages. However, its aggressive growth masked a precarious reality. In 2005, it was revealed that the company's CEO hid $430 million in bad debts. This deception shattered investor trust and Refco's credit lines evaporated. Despite having $33 billion in assets, the firm was unable to maintain liquidity, and the lack of trust led to its rapid decline into bankruptcy. Refco's collapse highlighted the fragility of financial institutions that lack transparency and sound risk management practices. Indymac Bancorp. Indymac Bancorp, originally a spin-off from Countrywide Financial in 1985, grew to become a leading producer of mortgage loans in the United States. Specializing in Alt-A loans, a riskier segment of the mortgage market, Indymac became a significant player. However, this focus left it exceedingly vulnerable when the housing bubble burst. A public letter from Senator Schumer in June 2008 questioned the bank's viability, sparking a bank run that saw outflows of $1.3 billion over the next 11 days. With $32 billion in assets, Indymac could not withstand the sudden withdrawal, leading to its failure and subsequent government takeover. Global Crossing. Founded in 1997, Global Crossing embarked on an ambitious project to create a global fiber optic network, a vision in line with the tech boom of the late 90s. The company raised massive funds and its network connected continents, promising a new era of global communication. However, the burst of the tech bubble and oversupply in the telecom industry led to a sharp decline in the company's value. With $30 billion in assets, Global Crossing filed for bankruptcy in 2002, marking one of the largest telecom bankruptcies ever, brought down by market overcapacity and unsustainable debt levels. Bank of New England. The Bank of New England, once a pillar of financial solidity, traced its roots back to the 19th century. By the 1980s, it had embarked on an aggressive expansion, particularly in commercial real estate lending. This proved disastrous when the real estate market collapsed at the decade's end. The bank's $30 billion in assets quickly dwindled as it faced a mounting number of loan defaults. In 1991, federal regulators seized the bank, marking it as one of the largest bank failures in American history up to that point. The institution's collapse was a shock to the system. General Growth Properties. Founded in 1954, General Growth Properties grew from a single shopping mall in Cedar Rapids, Iowa, to become the second largest mall operator in the United States. The company's aggressive acquisition strategy was fueled by easy credit prior to the 2008 financial crisis, which led to a substantial $27 billion debt load. The subsequent credit market collapse made it impossible for General Growth to refinance its short-term debt obligations, pushing the company into the largest real estate bankruptcy at the time. Lyondell Chemical. Lyondell Chemical, established in 1985 through the consolidation of several chemical companies, became a leading player in the industry. It grew through strategic acquisitions, including the purchase of Millennium Chemicals and a merger with Basell, financed predominantly through debt. This strategy left Lyondell overextended just as the financial crisis of 2008 reduced demand for chemical products globally. The company, with $27 billion in assets, was forced to declare bankruptcy as it faced a liquidity shortfall and could not meet its debt obligations. Wework. Wework's ascent and subsequent bankruptcy encapsulate the highs and lows of the co-working space revolution. Founded in 2010, Wework quickly became a darling of the startup world, reaching a staggering $47 billion valuation. However, its aggressive expansion and long-term leases against short-term rental income created an unsustainable financial structure. Post Adam Neumann's departure, despite cost-cutting and revenue spikes, the COVID-19 pandemic's impact on commercial real estate and shifts toward remote work presented insurmountable challenges. Filing for Chapter 11, Wework aims to shed approximately $3 billion in debt, though its future remains in flux with ongoing negotiations that could lead to further location closures. The company reported about $18.7 billion in debts compared to $15.1 billion in assets, underscoring the risks of its rapid growth strategy. POWA Technologies. POWA Technologies, founded in 2007, aimed to revolutionize the retail industry with its PowerTag mobile payment technology, which promised to seamlessly integrate mobile payments and e-commerce. Despite raising significant funds and reaching a valuation of $2.7 billion, POWA struggled to deliver a viable product to the market. The company was plagued by internal challenges and delays in technology development, which, coupled with a failure to gain significant customer traction in a highly competitive space, led to its bankruptcy. As we turn the last page of these financial epics, we're reminded that companies like empires can rise and fall. These bankruptcies aren't just ledger lines. They represent jobs, dreams, innovations, and sometimes decades of history. They remind us that one misstep can be fatal in the dance of supply and demand. But from these ashes often rise lessons of resilience, innovation, and the ever-present need for fiscal prudence. As investors, consumers, and business professionals, let's take these lessons to heart, ensuring the future of commerce is built on a foundation as robust as the aspirations that fuel it.